The clock is ticking. Welcome to QAV. This is episode 809, TK. We're recording this on the 4th of March in the afternoon, 48 hours before Brisbane gets flattened by Cyclone Alfred.
Alfredo, you gotta start calling it Fredo. I love you, but how could you do that to us?
You broke my heart. You broke my heart. Well, I tell you who broke my heart this week, Tony. Lots of companies broke my heart this week, including HLO, but we'll talk about that later on.
Yeah.
It's been another turbulent week on the stock markets. Lots of more half-yearly results, some good, some not so good. US market is also in a little bit of a chaotic state.
It's the market. Just the market in the US.
The market is a reflection of the general state of affairs over there.
The market's going, hey, come on, will you sit down? Quieten down.
Yeah, I thought I would, before we get into news, I might just touch in with our portfolio and see what's going on. Let's see where the dummy portfolio is at after all that. In the last 7 days, our portfolio is down 1%. The STW is down about 0.6%, so everything's been a bit down. Where are we for this financial year? We're up 11% for this financial year versus the STW, which is up about 8.5%. So we're doing kind of 50%, maybe 40% better than the STW for the financial year. So that's all right. Can't really complain about that, despite everything. In the buy list this week, there were, for people who are QAV club members and they're like, what is going on with the buy list this week? I did have somebody email me after I put out the buy list last week saying, what are all these sheets and pages and it's all so confusing? And I thought, well, maybe we've gone overboard with the amount of stuff we put in the buy list. So I stripped it right back to the bare bones this week. And then, of course, people complained that there wasn't stuff that they needed. So I'm going to try to find a hybrid. Look, I don't want to be doing stuff that people don't really need each week and aren't using. At the same time, if you need stuff, I want to provide it for you. So we'll try and find a nice balance in between the two.
I like it the way it is, frankly.
Well, yeah, but you don't have to do it. So,
Correct.
it's
so it's not because someone wrote to you saying simplify it. It's because
well, if I can simplify it and if I can do an hour's less work every week, I'm going to do it. I've got enough to do.
No, I agree. I thought you were doing it via AI. I thought it was all coded now. It was automatic.
The main part of it is, but then when I'm doing the commodity checks and I'm doing this and I'm doing that and new 3-point cells and there's other bits and pieces that I need to pull together, and it's a bit of finagling around, which I'd rather not do. Speaking of the commodities, the big one this week is iron ore became a Josephine and crude oil became a sell when I checked it yesterday. Didn't seem to impact my portfolio though, so I don't think I was holding on to any oil companies for some reason. Looks like oil's been a Josephine for quite some time, so probably haven't been buying oil stocks. Do you have any oil stocks as far as you know, Tony?
No, I don't. No.
There you go.
I think I did notice Woodside back on the buy list, but that's about the only one I can think of. Karoon's been on the buy list for a while, but I don't own it.
Looking at the oil price, it's been declining since it peaked in May 22, early days of the now defunct Ukraine-Russian war. By the looks of things.
I'm not sure if you're an optimist or a pessimist saying that.
De-Trumped. It's been de-Trumped.
Oh, de-Trumped, not defunct. De-Trumped.
I said defunct, but now I'm changing it to de-Trumped. Yeah. Well, maybe it's been trumped and de-Biden.
I was going to say, hasn't been de-Trumped.
Yeah.
His fingers are all over it.
Let's not get sidetracked into that whole can of worms. So yes, crude oil's a sell, but it doesn't seem to have an impact on our buy lists anyway. But if anyone does hold any oil stocks for some reason, You might want to pay attention to that. What else did we have on the buy list of note this week? New stocks entering the buy list this week was Karoon Energy, but it's a crude oil stock. Dusk Group, Yancoal, but coal is a sell as well. Fleetwood Limited, I had a look into them. They're a weird one. Ramelius Resources, that's good. Gold's a buy. Southern Cross Media Group, Woodside Energy, as you mentioned. I've got that as a buy because I think it's primarily LNG.
Gas.
Yeah.
And trying
Outweighs
very
the crude
hard to
oil.
expand its LNG. The government's holding up its 5-year renewal or
Our
5-year
old
expansion.
friends, our old friends Adares were back on the buy list this week, but I went to buy them yesterday for the light portfolio and they were having a down day, so I didn't end up picking them up. Haven't checked where they're at today. Perseus Mining back on, Rice Growers back on, and G8 Education, who I think you did a bit of a pulled pork on not that long ago.
Last year, yeah.
Okay, so PRN.
Continuing on with Perenti, and I'll try and just whiz through this because we've talked about it a couple of times now. It's a large ADT stock of some 2.5 million, so it'll suit most large or most portfolios for listeners. I own the stock. I'm still up. Well, it was 13% last week when I did the pulled pork after their results, but it's gone back up again now, so it's probably up more like 20% since I bought it. Last time I did a pulled pork on this company, they were going through the acquisition of DDH1, and the DD and DDH1 stands for Diamond Drilling, and Perenti is a drilling company, one of the world's largest, and DDH1 was on the buy list when it was around on the ASX. So Perenti has turned into a bit of an aggregator of drilling companies and mining services companies on the ASX over the last decade or so. Their website says we are an ASX-listed diversified global mining services group with businesses in contract mining, drilling services, mining support services, and technology solutions. The group was founded in Kalgoorlie in 1987 and is today one of the world's largest mining services companies, providing surface and underground mining at scale. They have 10,500 employees. They are operating 100 projects in 10 plus commodities across 12 countries. They have a number of brand names, so they don't necessarily brand everything Perenti. People may have seen or heard of the Barminco brand, which is one of the companies, again, that was listed and they acquired during the course of their life. Barminco is one of the world's largest hard rock underground mining services companies with operations in Australia, Africa, and North America. Perenti Drilling Services is one of the world's largest drilling services contractors globally, with the experience to drill the deepest and most complex holes in the mining and exploration industries. Perenti own and operate under the brands of DDH1, Swick Mining Services, Ausdrill, and Strike. And I think all of those were on our buy list in the last 5 years, listed on the ASX, and Perenti saw as much value in them as we did and swooped them up. So that's them. They also have a technology division called Idoba and Orology, and they use their knowledge to plan and improve efficiencies at mine sites through their technology offering. Latest results. So last week, the day of the results, the share price was down 18%. That was down to $1.12. This morning, when I had a look, they were back up to $1.30. And pre-results, they were at $1.40. So they haven't quite recovered everything they dropped, but they're getting back there. They never became a rule one for me or a 3-point trend line sell the whole time. So they were far enough in advance of their sell line to just enable me to ride through this. They're an ASX 300 share. They reported a 6% increase in revenue to a record 1.73 billion. They had a 3% lift in EBIT, and what else? They did call out a fall in net profit to 64 million. So that's probably what Simply Wall Street was talking about. But yeah, I made the point in my notes from last week. What was caught the eye of investors was its free cash flow generation. It recorded negative free cash flow of -11 for the half due to late debtors. However, they reaffirmed their guidance for FY25, as I said. They continue to expect revenue in the range of 3.4 to 3.6 billion, EBITDA of 325 million to 345 million, and yeah, so that was reported in Motley Fool. Here's in Perenti, lose 18% as investors fret about weak cash generation despite CEO's assurances, was the headline in the West Australian. That was behind a paywall, and I wasn't prepared to pay to read the article, given I picked up most of the gist elsewhere. What else? MPAT was down 6 million, so down roughly 10%. However, management highlighted that there was a $29 million non-cash gain on acquisition of DDH, one recognised in the first half period of last year, and that's why their NPAT was down this half, because they didn't have that write-up. Again, I think I made the comment last week after the results that these, I would like to say that they are applying this accounting standards rigorously. So what happened last year was the DDH1 acquisition worked out better than expected, so they made more money from it, and therefore someone said, well, we only paid this for it, we should really write it up on our books. And so they increased the equity value of, or the asset value of DDH1 on their books. That's something that you rarely see in corporate land. Why would you do that? Because you may have to write it down in the future, and it's really just playing with numbers on the balance sheet. It's not affecting, it's affecting the numbers in the net profit line, but it's not actually changes in cash. It doesn't affect cash flow, either operating cash flow or free cash flow. Anyway, they did it, perhaps, to look good. But anyway, they didn't have it this half, and so net profit looked bad. Now, maybe that was the trigger for the downgrade that Simply Wall Street seems to think it was, but unless this was like complete algo trading, any analysts, I think, would look at that and go, okay, for some dumb reason, they wrote it up last half and it's not there this half. The underlying looks in line, looks okay. So I wasn't that worried by it. The other thing that they did during the half was pay down some debt, which was good. I thought the result was fine, but management are going to have to calm down on their accounting manipulations. I think it's just not a good look to have to dig and dig and dig and dig to work out what's going on. If there are issues, just call them out. Tell us about someone paying late. Who were they? Is it going to happen again? They could have put a graph of their 90-day debtors trend line in the pack or something like that, just to put some context around it, which they haven't, unfortunately. Anyway, the QAB numbers for Perenti. This was last week, and when the share price was $1.16, but I was using the latest result numbers, so the QAB score may have gone down a little bit this week, but it's still very robust. The price was below consensus target. I have IV1 at 44 cents and IV2 at $1.91, so it's above IV1 and below IV2. Yield was 3.45% when the price was $1.16, so it's going to be less than that now. So too low for us to give it a score on our checklist for that. Stock Doctor Financial Health and Trend was strong and steady. So, whatever numbers they're using, they're not worried about the late payment. Stockopedia have an F score for health of 6 out of 9 and a quality ranking of 82 and an overall ranking of 96. So 6 out of 9 is, getting a little bit on the low side. I think we score at 5. We stopped scoring at 5 out of 9 from memory on the US buy list. But anyway, so it's Stockopedia are calling it out as being okay for health, but not great. But overall, they're seeing a ranking of 96 out of 100 based on the fact of the value ranking being high. PE is 13.5 times. It was in the mid-range for the last 3 years, so we don't score it for that. PropCAF is 2.3 times, and this is the real kicker why it's high up on our buy list. So we're seeing terrific value in the company. I take Toby's point, that they may actually use some of that prop cash to buy equipment or whatever, and so free cash flow might be more important. But at least at an operating cash flow level, it's very cheap. Net equity per share is $1.93, again, which was higher than the share price, so we can score it for that. I will call out net tangible assets was $1.29 after the latest results, so the share price is around that price today, so we were still able to buy it even at net tangible asset value. And it's below net equity per share by some 80 cents or 75 cents, largely again because of the fact that they've been acquiring all these companies, and the goodwill is hurting their net tangible assets. But like we saw with DDH1, if they paid a good price, it won't always be a negative NTA to net equity per share. Anyway, either way, you can buy this company for less than its book value on a net tangible asset basis, definitely on a net equity per share basis. Earnings per share is forecast to grow 132%, and that means growth over PE is 9 times, so well above our threshold. There is no owner-founder, so it was founded back in Kalgoorlie in 87, I think, so the founders shuffled off. It is currently scoring in the buy list for being a recent 3-point trendline upturn. That was of last week, but I think it's been a buy for a while from a sentiment point of view, so it lost that score after the new results came in. The company has 5 halves of consistently increasing earnings, which is, again, a telling thing to suggest that the company's on a strong financial footing. All in all, the quality score is 13 out of 16 or 81%. QAV score is 0.35, which is quite high up on the list. I did list last week when I was going through the results, as Toby has, that one of the risks is that the debtor late payments really is a problem. And if it occurs again, I think that would be a red flag, or if we start to see something coming out of management saying that they are getting more late payments, that's a problem. They've given us a large forecast in earnings per share to grow of 132%. I don't know how conservative that is, but such a large forecast carries the risk that if they miss it for whatever reason, that will tumble the share price as well. Mining has been strong, not so much in coal, but iron ore recently, I think, turned into a commodity buy. Like St Josephine, I think, today. And gold strong. So mining is pretty strong at the moment. So even though there's a risk in the future that it turns down, it's pretty good at the moment. On the positive side of things, great prop cash price ratio. Debt payments are down, and they're continuing with their buyback, which is always a good sign. And I'm in the background working to put that into the buy list in some shape or form. So I think that's a good thing too for them.
Thank you, Tony. PRN.
But have a look, do your own research, debate it with me like Toby has, and make your own mind up. And if you are out there and your stockbroker has done a research report on them, ask them what they think of that late debtor problem. They may have some more research which we never got to see or hear. And the interesting thing too is I went through the management call on the announcements on the results, and they cut it off before questions were taken. So I thought that was interesting as well.
Who are they, Donald Trump?
Other conspiracy theory.
I hold them in a few portfolios. One of the light portfolios, bought it back in May 2024 at $1.01. It's up 29%. We added it to the dummy portfolio about a week later at $1. It's up 31%. I added it to my super 6 months later, November at $1.21. It's up 8% since then. So yeah, it's had a good run share price wise in the last year or so.
Yeah, look, I think it's a good company. But please don't take my advice. Go and do your research and have a look at it yourself as well. I'd be interested to know what's going on with, like, when these results announcements come out and the share price moves so much straight away. It's either analysts forming a very quick opinion, or there's some kind of algorithmic trade going on, which is, running through a summary of the results and going good, bad, good, bad, good, bad, buy, sell. And, without having the proper management context, which is management's fault, not the AI's fault, the shares are being tossed around. That's one explanation for it. I'm not sure what happened in this case, but it's been a strange one, I thought.
All right, TK. Well, that gets us into after hours. What have you been up to this week?